Welcome to Treasury One's Market Review, and as predicted, last week was all about US interest rates, with the Fed moving it up by 25 basis points as expected. And taking the statement and the presser which followed the announcement into account, it's clear the Fed will now pause and stand back to see whether it has done enough over the past year to tame inflation, with the rate cut to only be expected by 2024. But that's not entirely what the markets are telling us. They're expecting the Fed to pivot before then, perhaps as soon as July. And it comes as the cracks are showing up in the US economy. And then there's the stress in the small and medium-sized banking sector. Now, these banks are an important cog in the American economy. According to an article by The Guardian, they account for nearly half of all US consumer and business lending, making them a big deal. Last week, PacWest became the fourth US bank this year to face troubles. And while they have different reasons for their troubles, a tight monetary environment is the common denominator for the wobbles between all four struggling banks. Now, both the Fed and the Biden administration was very quick in their attempts to allay fears of problems in the sector, but the system will only hold as long as there's trust. And should investors act on any lingering fears they may have, we very well could see more troubles in the sector. Now, before we move away from the US, it should also be noted that Jerome Powell went against the Fed's own forecasters in saying America may be on track to avoid a recession this year. Then over in the Eurozone, the central bank followed in the Fed's footsteps and upped rates by 25 basis points in line with expectations. But seeing as they lag behind other major central banks, at least one more hike is to be expected. It also comes as last week's CPI for April showed a slight slowdown in the bloc's inflation, which could be an indication that the worst of the inflation episode may be over. Meanwhile, those who have been holding their breath for a Chinese boost to global growth will have to hold it for a little longer. April's manufacturing PMI and services PMI, both released last week, reveals an economic recovery that remains patchy as the economy struggles to gain traction after its prolonged pandemic lockdown. The latest outlook from the World Economic Forum now shows a split among experts on what we could expect for the rest of 2023. 45% of economists surveyed say a recession is likely, and 45% says it's unlikely. There are some other measures that we're tracking which, based on historical performance, are giving some strong hints to which direction the global economy might flow. One of them being the gold-oil ratio. Now, I did a quick take on this metric in another video which Treasury One has shared, and whether or not this ratio supports the recession argument or not. Some local second-tier data is scheduled for release this week. The March numbers for both mining production and manufacturing production will be out on Thursday. Now, mining is facing a very tough environment. Commodity prices are tracking sideways, which puts sales under pressure. The country is also facing challenges to new exploration investment, with the added strain of load shedding and a weak policy environment. So production has been contracting for more than a year, and we expect this trend to have continued in March. Now, things aren't much rosier for manufacturing. It remains one of the worst hit industries post-lockdown. Manufacturing production remains between 8 and 10% down from pre-pandemic levels as load shedding intensifies and infrastructure failings hamper growth. So we expect another contraction for March of 5.8% year-on-year. As for international data, Wednesday sees the release of April's CPI figure for Germany. We're expecting a slight slowdown in inflation year-on-year for Europe's biggest economy, and the US will also be releasing its inflation data for April on Wednesday. The CPI reflected the cooling effects of the tight monetary conditions as the index slowed to its lowest levels in March in nearly 2 years. Now, ETM anticipates this to remain the case for April, with the downward trend being slower than what the Fed would like. Then on Thursday, after the Brits have wrapped up their pomp and ceremony from the coronation, the Bank of England will announce the latest interest rates, with a 25 basis point hike already priced in by the markets. The focus will be more on the accompanying statement to give some direction on the BOE's possible plans going forward as it seeks to balance expectations with an economy that looks set to slip into a recession. Now, the country's GDP for Q1 is scheduled for release the following day, with a slight expansion of 0.1% expected. As for the rand, the currency remained on the defensive last week as it struggles to capitalize on any US dollar weakness. It depreciated against the British pound to levels last seen at the onset of the pandemic. And that being said, the rand's undervaluation continues to look stretched against all three of the major currencies, giving exporters the opportunity to take advantage of these attractive hedging levels, while importers would do well to bide their time for a little longer. That then the week that was and the week to come for the markets.